Do you believe the rally we've seen in the equity market, or do you believe the data?
I think the data is looking backward somewhat, and so we've been anticipating resurging growth in China just based on the massive easing that has gone on in Beijing and around the country, obviously. So we're pretty optimistic for the cyclical and sectors, and we've been increasing our weighting since last fall.
At the same time, some of the numbers have been disappointing, like retail sales.
Totally.
Here in the United States, it's been really a little disappointing. Does that give you some cause?
Yeah, I mean, the data are mixed, right? I mean, you see durable goods orders were terrible, but the manufacturing PMI and the non-manufacturing, which we'll get today, are still expansionary. Retail sales were bad, but the wage numbers are good. So it's hard to make any sense out of the numbers in the near term. You really have to normalize and look out over the long term.
So, Brian, how much of this is really fundamental economic driving, and how much of it is really the central banks, particularly the Fed, backing off?
Well, let me first say investors should have FOMO because these markets are likely to go higher. The macro environment is slowing. That's good news. Last year we had very, very strong growth on the back of stimulus, but we had multiple rate hikes and a move in the 10-year rate to 3.25. This is still an interest rate sensitive economy, so we're slowing. The stimulus is fading. The Fed rate hikes took a large bite to U.S. economic activity. Slower growth and a Fed that's backed off is actually a really good environment for equity markets.
So this is what I'm finding interesting. So both of you are going to be liking equity markets, but Nancy, you like it in part because some of the data is stabilizing and doesn't look too bad, and you like it because the data looks bad. So
well, I wouldn't call it bad.
But
I'm calling it
slowing. But the
data
points are slowing.
And a Fed that's backed off.
Right. So at some point, does one of you have to cave? Like, you both can't have your own way.
Well, look, I mean, I think we're sort of saying the same thing. I mean, there is a mixed economic picture, but the U.S. economy is not, there's not about to be a severe economic disruption in the United States. Severe economic disruption usually happens with really tight monetary policy or big excesses that exist in the system that have to be worked off. We don't have that right now. The Fed's on the sideline, and there's no real excesses, even in valuations. I mean, even if you know, earnings are $160, you assign a 20 multiple on that, which is not that high in a 2.5% interest rate world. That suggests equities are going higher.
So, Nancy, I don't want to rain on anybody's parade, but I do want to push to make sure I understand what's going on. I'll put a different way of looking at what's going on. This is OECD leading indicators, and across the board, they're headed south, as a practical matter. Should we feel good if, in fact, what has happened is the underlying economy is not doing so well, but the central banks are essentially pumping in liquidity? By the Fed backing off, that's a way of pumping more liquidity into the system. Is that really good growth?
Well, no, as you phrase it. I think what we need to see is a resurgence in CEO confidence so that CapEx spending will increase. That's my biggest worry right now. Right. And it doesn't seem like Washington is too concerned about that. They are, you know, I mean, they're going for the deal they want to go for with China, but it has caused CapEx spending to slow and CEO confidence to wane. And so if that doesn't change, then I think we are in a situation where we're just propped up by the central bank, and that is not a good place to be.
So as we head into first quarter earnings season, do you expect that to say, okay, this is the trough, things are going to get better, or do you expect it to sort of affirm low bond yields, things aren't great, we're concerned?
Well, I think the market's anticipating earnings being kind of not good.
But looking ahead to the back half when things get better, that's what it feels like the markets are looking at.
Right, and that's what we're looking at, and we think we will see that in the coming months as we begin to see the fruits of the easing in China.